Today's topic is the primary reason I started this YouTube channel, and I think it's one that every investor needs to hear. You are throwing away hundreds of thousands of dollars if you invest with a financial advisor, or worse yet, if you don't invest at all. Stay tuned for this one, you guys, because I promise it'll have a drastic impact on your future wealth. I'm going to share a real-life situation that I ran across recently when I helped someone take control of her financial future. I've seen too many of these to count, and I've yet to come across one that even sniffs the results of long-term index investing. And your situation is no different if you're using a financial advisor to manage your portfolio. In this video, I'll show you how to assess your current situation, and more importantly, I'll show you a simple way to blaze down your path to financial freedom. Zero investing experience required. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please annihilate the like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind while you watch this video. Let's grow. Your portfolio is bad by design. I've analyzed a lot of professionally managed portfolios, and they all use a similar set of rules. Some of them are set up better than others, but none of them are unique. The basic concept is to build a portfolio based around the investor's age, risk tolerance, goals, current wealth, and work situation. Younger people will generally have a more growth-oriented portfolio, whereas people that are retired or close to retiring will have more dividend ETFs, bonds, cash equivalents, and dividend stocks and things like that. And financial advisors are professionals. They do know how to build a portfolio based on these factors. But there is a major problem at the core of all these portfolios. The professional managers will not allow the investor to roll with the low-cost index funds within each category. This, my friend, would not allow them to experience their next fancy vacation on your dime. If you ask your financial advisor, just as an example, to invest some of your funds in the popular low-cost S&P 500 ETF, VU, they'll very likely say that they don't have that one available, but they do have one that's like that they think will do better. They are incentivized to invest your money in actively managed high-cost funds. And it is a straight-up fact, not an opinion, that these actively managed high-cost funds consistently fall short of the low-cost indexes over any stretch of time. And that's why I mentioned earlier that they do know what they're doing. They set up each type of fund based on your age and all those factors we talked about earlier, arguably close to what they should be. But each selection within those categories will be the high-cost, lower-performing versions over time. If you look at it, the high-cost actively managed growth ETFs that they will put you in have probably outperformed a lot of the good low-cost dividend ETFs or, stashing cash, treasuries, money markets, bonds, and things like that over the last decade because it's been a bull run of a decade. But those growth ETFs that they had you in probably severely underperformed the growth ETFs you should have been in per that category. And the problem is compounded when you add in what is normally a 1% assets under management fee in addition to these high-cost actively managed funds. And we're going to dive into some examples later to show what I mean. And I'm not trying to be a hater here with this video, and I'm not trying to be condescending in any way, shape, or form, but it just gets my blood boiling knowing that they know exactly what they're doing for all these portfolios that they're managing. You deserve better than that, and the solutions really are simple. You don't have to be an experienced investor to get positive results. The underperforming portfolio. We're going to take a look at the funds that a professional advisor had a 20-year-old in. And these are the exact holdings. No flavor was added by yours truly. Okay, so here are the holdings that she had. And these are the ticker symbols. It's a lot of tech and energy, and there's some more conservative bonds, but it's just a mix of what they deem to be best for a 20-year-old. And this is in a Roth IRA. So I put the expense ratio of each one of their funds. And in the defense of this manager, the 0.50 or 50 basis points of an expense ratio isn't too bad for a weighted expense ratio from what I've seen on a lot of these portfolios. And you can see here the amount that she had in each one of these holdings. And this is just the percent allocation of the portfolio. So it adds up to 100. She had about $4,200. And here's the 5-year total return. And I use 5-year total return because some of these funds were not 10 years old. So we had to have a standard that every holding met. So you can see here, this is the 5-year total return for each fund. And this is a sum product for the weighted average 5-year total return here. And then to do the CAGR, this is a rate of return formula so everything's weighted. This mix here had an 8.11% annualized return. And now this is just what I would have her in instead. And you can tweak this. Remember, she's 20 years old. So I'll address the yellow one first. I would have her in QQQM, which has an expense ratio of 15 basis points. However, QQQ was used for this data, it follows the exact same index because QQQM didn't have the age on it. So QQQ is 0.20%, as many people know, but I would have her in QQQM, which is 15 basis points, if you're wondering why the confusion here. So I said something like half of the money in the market, or VU, the S&P 500, and then half of it in growth ETFs, and I like VGT and QQQM. So this would be fine for a 20-year-old who's cost averaging in and never selling for the next 30 years. Huge drawdowns don't matter. Now, I put some other options in here so you can see the return. The CAGR's been 18%, and it's been an incredible 5 years. Although, as you can see, it hasn't been an incredible 5 years for what she's actually invested in. The reason I have these other options is, let's just say we're gonna go 0% into this, and you just wanna roll 100% with the total US in stock market. You're still up 13.7% in this duration where she only had 8%. If you really wanna go, okay, what about international? Even 100% VT, which is everything, all international and US stocks with no overlap, is 10.46. And more realistically, maybe someone, even a conservative person, would do something like this. This gets you about 20% international and about 80 US, has a return of 12.1. So no matter how you slice this, you should not be getting these kind of returns. And the scary thing is, you guys, we have not added the assets under management fee to this, and we're going to do that next. Ouch. But I'm gonna put this back to about 50%. Let's just, let's be a little more conservative. I'll put this back to 60, 20, 20, and we'll say 17.5% return. But even if we return 12%, way under this, and this returned 8, which the gap will never be that close with these holdings compared to these holdings. But let's just look quickly at what a 4% difference does to our returns. To check out this scenario, we're going to use my portfolio projector Google Sheet, and this is out there for all the members of the channel. This is one of the spreadsheets that's included. But what we're going to do here for this scenario is we're going to put in a starting portfolio value of $0. She's brand new at 20 years old. We're going to contribute $500 a month, so get close to maxing out that Roth. Date of birth, we're just putting today, so we can look at this in years. Normally I have this where you put in your own date of birth and it'll show exactly how old you are, so you can project out your scenario. But we're just going to go with today. And 12% growth. So in 40 years, that 12% growth of the growth ETF mix that I had along with VU would be at 5.8 million. Now let's say, and it was 17 or 18%, but it's also been a bull of the last 5 years. Let's just say that we go 10% with the ups and downs. We never sell, we buy in for 40 years. That's a cool $3.2 million. Now, if you put in 8%, and with those crummy funds, frankly, I don't think 8% is realistic, just like I don't think 17 is realistic for the good ones. In 40 years, you're at 1.7 million, compared to, realistically, it'll be at least 4% better, 5.8 million. That's the power of compound, you guys. And the sad thing is, with the 8% from the financial advisor, you're only going to be keeping about half of this. We haven't even done the assets under management fee. It gets uglier. That situation is sadly not unique. Helping people avoid this robbery is genuinely why I started this channel. I was not exaggerating when I mentioned that earlier. Investing in something as simple as an S&P 500 ETF like VU, or a total US stock market ETF like VTI will consistently outperform the results net of fees that you'll get from these professionally managed portfolios. And the sad part is, we haven't seen all the costs add up yet. Let's get into more of that pain right now. The fees add up. You will normally pay about a 1% assets under management fee to have the professional manage your overly complicated high-cost portfolio. And 1% seems reasonably low until you see how it compounds over the years. Let's go take a look. NerdWallet has a great mutual fund calculator available online, and this allows you to calculate how much an expense ratio of a fund adds up to cost you over the years. So in this scenario, I just threw in some basic numbers for a beginning investor. I said we started with $2,000 and we're putting in $500 a month, which this is an annual contribution, so $6K a year is $500 a month. Rate of return is 10. We're gonna say that financial advisor can meet us in the middle of what we were getting on our good portfolio versus the bad 8. Time, they won't get this high, by the way. Time horizon is 40 years. And the fund expense ratio, I put it at 0.5%. Like the one from our example. And I already hit calculate here. So you can see that the ending value is just over 3 million. The ending value net with fees is 2.6 million, and the fees cost us 400,000. And I will say these expense ratios are lower than I've seen. I've seen about 1% average, and check out the difference of this. Just 1% gets you to 740,000 of fees, and it only leaves you 2.27 million. But we are only at 0.5, so that's actually good. But remember, this does not include the assets under management fee. So what I've done is I've recreated this logic in Excel. So you'll notice these numbers right here should carry over when I tab over to our Excel sheet. There's that you have number, and there's that same true fee. But I want to explain how this works. So you can see I have the same beginning 2,000, contributions 6K a year or 500 a month, rate of return 10%, and expense ratio is 0.5. So I've recreated that scenario, but this is a little more flexible. And I'll put this out there for the channel members. So you can see I have the same 40 years, and here's your ending value after the fees. But I wanted to point out a couple things about how fees work. And we haven't added the assets under management. You're going to get a little sick to your stomach when we do. So you actually only paid 125,000 of fees. That's what you literally paid the person, the nominal dollar amount out the door. But the true fees considers the compound effect of the rate of return for the money paid that isn't there. So the opportunity cost, or the true fee, is 400K, even though you only actually paid 125,000 out the door. So this is what you'll have advertised to you for those low costs, but this is what it actually costs. And now I'm gonna do something that will make you a little queasy. This is standard 1% assets under management. Now, your true fees paid over that 40 years is just over $1 million, and you only have 1.9 million left. So they've taken 35% of your money. Again, you've only actually paid 319, but it has cost you 1 million. That's how the compound of this stuff works. And you can see here's your ending amount. Here's your yearly assets under management. And I have this broken down into 5-year chunks, just so we don't have to see everything. Don't have to scroll so much, and you can expand it here if you would like for each 5 years. But that's how scary these things add up. Remember, with our expense ratio of about 0.08 and our return conservatively with those growth ones of 12% and 0 assets under management because you're doing it yourself, you're left with about $5.2 million after 40 years. Now, when you put in and you've lost about just over 2% to the compounding fees, and that's just this expense ratio. When you put in a more realistic, for the financial advisor, 8%, and frankly, that's if that. Because if you're gonna say 12% on ours when they've really been 18, but it will slow down. 8% is what theirs has been, but it will slow down. But let's just say rate of return of 8, expense ratio back to 0.5, and assets under management 10. You just went from having 5.2 million in your pockets at the end to 1.1. And again, you guys, this is not exaggerated. This is how these figures add up. You can see why it's my most passionate topic within personal finance. It is the silent killer. I know investing seems scary when you first start out, and it seems like it's best left to the professionals. But as I've shown in this video, you are losing a huge chunk of your hard-earned cash when you take this path. There is a lot to learn about the nuances of investing, but as I mentioned earlier, there are really simple solutions to get started. Once you get on the path of avoiding these compounding fees and slowly evolving your portfolio to make it what you need based on your situation, you'll never look back. I've mentioned it in other videos, but I think M1 Finance is a great place to start for the passive long-term investor. And there's a link in the description below if you want to take that route and get started and get hooked up with a little free money when you open an account. Thanks for listening to this one all the way through. I know it's not the most exciting topic, but it is what I view as the most important topic in investing. Please share this video with a friend or a family member that is currently rolling with a financial advisor. It will genuinely change their life forever. Check out one of these two videos if you want to learn more about investing after cutting the cord with your financial advisor. Thanks for watching, and I will see you here each and every Sunday, and sometimes on a Thursday. Peace.